morning, everyone. We're very excited to share with you, run this webinar and share with you some insights on the 6-month retrospective of the 15-minute day ahead auction products. So without further ado, I'll start. Okay. So let's look at the agenda. I mean, we're gonna start with providing some context behind this 15-minute shift. Then I'll be diving into the volume, the patterns we observed in the volumes and the bidding strategies.
Hamza, I'm seeing your screen if you don't share it.
Okay. So you don't see.
I don't see your screen, but let me know if others do. I don't.
Actually, I see your screen, and I think others also do.
Okay, thank you. I'll manage.
Okay.
So do you still see the screen, Kristen?
Now I actually don't see the screen.
Okay.
But I saw it beforehand.
Okay. Let me.
Yeah. Looks good.
Yeah.
Okay.
Great. Thank you.
Nice. Yes, on the agenda, so starting with the context, I'll dive into the volumes, patterns, and the bidding behaviors, and I'll hand it over to my colleague Bruno, who will more focus on the Sawtooth pattern, how we developed, and most importantly, how we cope with this in our forecasting models. We'll have some room, as Kristen said, for at the end for Q&A. So feel free to post your questions in the chat. So the context, everything starts, with the grid security. The TSOs have the responsibility to ensure that the grid is balanced in real time, and this task has become more complex and more timely in the recent years due to the increased share of the renewables in the mix. Historically, we had the consumption side of things that was weather sensitive, where in recent years we moved into a situation where an increasing share of the supply mix is becoming weather sensitive, which leaves the balancing the TSO with the challenge to adapt the balance to a cloud coming in or a sudden drop in wind. So in order to ensure the security, we needed a system that let's call it the financial system around power markets to get closer to the physical reality. And the first step was for the TSOs to transfer the responsibility of shorter granularity imbalance settlements to market players, which means that before a market participants had to be balanced every 30 minutes, and we moved into 15-minute settlement periods with the latest countries that saw this change was in early last year in 2025. So now, once we have imbalances being settled for every quarter hour, it's only fair to provide market participants with the ability to balance themselves on a regulated market to balance their positions. Even though we had quarter hourly products on the intraday markets, it was lacking. I mean, we lacked reference price for a given quarter hour, and that's why the day ahead market needed to move into these 15-minute products to provide this reference price for which market participants can trade and balance their portfolios. So as of 1st of October last year, the single day ahead market coupling, basically the common European market, moved at once into from 24 products being traded to 96 products being traded every day for 96 prices. Before we dive into the insights, wanted to share with you a very short reminder on the short-term power market sequence. So here we're gonna look at the delivery day where actually power needs to be delivered, and everything starts with the day-ahead auction. So it's as it says in the name, it starts the day before at noon. There's an auction that will, participants will bid, will share their bids and offers. There's gonna be a price reference for the next day with volumes being committed by participants. Once the auction moves, just a few hours away, there is the first intraday auction at 3 p.m., then followed by a second one at night, and a third one in the morning the next day. These intraday auctions help rebalance the remaining balances, any change in weather forecasts, if there is an outage in demand forecasts could impact your position, and these provide you, an opportunity to rebalance. In parallel of these auctions that were introduced a couple of years ago, we used to have what we call the intraday market, is the intraday continuous market. This is not an auction. It's a continuous trading scheme. It works, you have a common order book where people put in orders, buy or sell orders for the required amounts of energy and the desired price, and the single transactions are getting executed. So this has been and is still the most liquid way to trade on intraday, and auctions were introduced a bit later. Once all the wholesale trading part is over, we look at settlement periods. As mentioned, these periods became at 15-minute granularity. And here what happens is, the TSO will look at every quarter hour, look at what's the supply demand for each participant, and settle the difference with the market participants at the imbalanced price. Now that we've set the context and how all of this works, we look at the volumes and bids, and really the first place wanted to start with is the day ahead volumes. What you're seeing on these charts, on both charts, is actually the daily traded volumes in the CWE region, which is Germany, Belgium, Netherlands, and France. These are focused on spot volumes from Epic Spot, which is most liquid exchange in the region. And the red curve is the 30-day moving average, trying to cancel out any noise and really see the trend behind it. And what we see on the top charts is that across the region, we see a very sharp increase of about 25%. That actually we noticed in the first months after the change, but it's really a tendency that continued for the following 6 months, reaching 300 gigawatt hour increase on a base which is 1,500 gigawatt hours. And to isolate, we put some history for the full year of January 2025 to isolate the fact that there's seasonality. There might be more volume traded in winter as there is more demand required to be met. But even if we look at this year on year, there is 20% plus increase. And on top of that, on the bottom chart, you could see the same daily trading volumes, but for the Swiss market, for Switzerland, which is outside of the single day ahead market coupling, which means that they didn't move to 15-minute product on 1st of October. They remained, I think it's 30-minute products. So for them, there was no change at this given date. And we can observe that no impact on volumes have been observed in this market, which shows that really the trigger for this increase was primarily driven by the shift in market granularity. Now, if we break down the first chart, for the region on individual countries, something I wanted to answer is the increase harmonized across the countries? And I'll try to break down here the charts. Basically, all the countries saw an increase in volume. The biggest increase are observed in France, both in absolute value and in percentage, followed by Netherlands in percentage and Germany. The drivers really that can be identified is, first, there are more market participants in the day ahead in the market. This is something reported by Epic Spot. It keeps on increasing. March is yet another new record of the number of participants. But there's also more trading opportunities for flexible assets that can benefit from 15-minute products, which means that if you are able to either dispatch or speculate on these products, then you were already doing this on the intraday, it only makes sense to add the day ahead 15 products and make some arbitrage between the day ahead, the intraday auctions, and the intraday continuous. It offers a range of possibilities that the most advanced participants and the most flexible assets could benefit from. And the last one, I think it's an important one to consider, is that there's an increase in the penetration of merchant renewables. So there is an increase of renewables overall, but there's also more renewables, getting out of subsidies and entering the day-ahead market to sell their volumes a bit more, and all these factors will contribute. One specificity for France, because it went well beyond the others, there was a regulatory change in France where, for the past 14 years, the EDF had to sell part of its nuclear generation at a fixed price to other retailers in the market. And this has come to an end on 1st of January this year, which means that the volume in the preset volume was 100 terawatt hours. Part of this volume might have come as well on the day-ahead markets as of 1st of January. So that could have accelerated, here in this area here. So this is December and this is Jan. This could have accelerated the growth for France, with more volumes being put into the market that were sold not bilaterally, but regulated through long-term contracts. Now, the next question we wanted to address is, okay, there are many drivers, but there's also the question of how much of the intraday volume have been stolen, cannibalized by the new day-ahead quarterly products. And that's what we try to display in this chart, where we look at the weekly volumes for on the intraday. In purple, you'll see the intraday continuous volumes, and in gray, the auction volumes. At a glance, we don't see, really a strong tendency of increasing or decreasing volumes. There are some outliers depending on the market conditions, but overall, it's going to be quite flat. However, we wanted to dive a bit deeper into each market to see if there are not some hidden effects out there. So first, on the intraday continuous section, there are two types of products that you could trade: hourly products and quarter hourly products. And yes, and the thing is, on both, there is no structural change that happened. So here on the top chart, this is the 30-day moving average of volumes on the intraday continuous hourly product, and on the bottom, it's for the quarter hourly product. After 1st of October, we really see a clear flat line, which is no immediate trend and change in volume out there. Obviously, we can see some drops due to the seasonality and the holiday season and the decrease in volume in general, but nothing really related to this market. Just wanted to explain this 40 gigawatt hour drop and actually shift from hourly products to quarter hourly products. This has been driven by the French market, where they observed the shift in summer last year. But other than that, no immediate effects. However, something less related to the 15-minute shift, but we see a recent tendency over the past few months of increasing volumes in the intraday continuous market, and more specifically on quarter hourly products. This shows the market appetence in general of trading, of entering the intraday continuous markets, and looking for opportunities there in order to leverage any market structure. So now we're going to do the same exercise, but for the auctions. Here the story is a bit different. On the auctions, we clearly see a drop literally overnight on the intraday auction 1 volume, so the orange-ish bars. And this is something that we were expecting to, as the first intraday auction happens shortly after the day-ahead auction, so it doesn't leave a lot of room for inputs to change. So it only makes sense that some volumes were shifted from the intraday auction to the day-ahead, as not many market participants had positions changed between the two auctions. So this was our conclusion when we did the first analysis just a few months in. However, what the important thing now is that it's really a stable effect. It's a structural effect. The intraday auction 1 lost volume that which will not recover, at least not in the short term. It's really a structural shift where we got to a level where intraday auction 1 and intraday auction 2 have similar volume levels. So this 20 gigawatt hour of extra volumes have been absorbed by the day-ahead markets. So now, once we looked at the volumes and the impact there, and all the bright future power markets, short-term power markets have, we wanted to analyze how the bidding behavior evolved since 1st of October. So to keep in mind, on 1st of October, the products moved to 15 minutes. However, market participants have the ability to bid in 15 minutes, 30 minutes, and hourly products. We didn't see any other option of the 30-minute products. However, there's a clear tendency, the products that are being used are the 15 minutes and the hourly. What we wanted to track is what's the evolution of the share of hourly bids in the total amount of traded volumes across different countries, and see if we observe any patterns there. So the top chart with the box plots shows for the last 6 months what is the share of hourly bids in the supply side and on the demand side as well for different countries. And the first thing that we can observe is huge disparities between countries. I mean, we have Finland or Norway that we have a very strong adoption of the 15-minute products and almost close to no hourly bids, where countries with let's say a more thermal stack, a more outdated fleet, such as Romania, Poland, Austria, will be on the upper end of this side. Second thing is the share of hourly bids is higher on the supply side, which again is to be expected as the old fleets and the thermal stack is the main driver. It could be the main driver for these orders. So we expected this higher share on the supply side rather than the demand side. And once we've observed this, and honestly, we plotted this chart 4 months ago, and the picture was exactly the same as what you see today. So we're curious just to see how it evolved over time, because at least the disparities stayed there, but how the overall share across Europe evolved. And this is the bottom chart where we focus on we look at all the countries. We look at the average 60-minute or the average share of 60-minute orders across the total volume traded on all these countries. And even though there was a sharp decline over the first weeks and months, we really are in a stage where we're getting in a new regime, stable regime. Around 15-16% of total orders are being submitted at hourly resolution. This has several messages. I mean, first of all, it might just be very difficult to some market participants to switch to 15-minute products. It's not only the bidding system they are using, but it's also the dispatch of their assets. Are they able to dispatch a coal plant up to hour and 15 minutes or hour and 45 minutes? That's not an immediate, there is no immediate answer to that. And second of all, there might be not enough incentive, or at least perceived incentive, for them to invest in this huge change. And as from what we know, there is no announced date of deprecation of hourly bids. So really, there is no timeline for them to stop. So for all these reasons, we are in this situation, and it's expected to remain at this level for in the near future. Who knows? Maybe in a year or two, we'll do the analysis again and could observe a trend. But clearly, it's not just some market participants that have been slightly late in making the transition. I think some didn't at this stage invest and plan on doing so. So now on the next section, I'll hand it over to Bruno. Who will dive more into the price shape impact, what this shape is about, and Bruno, I leave it to you.
Thank you. And you said it all. So let's look at the shape of this 96 blocks per day new day-ahead prices on the market. In terms of time series, next slide shows you what it looks like for one specific week, last year in Austria, where in red you have the day-ahead hourly average price. And what really materialized in the market is the blue line, which is the 15-minute day-ahead price. What's striking is the operation of a Sawtooth pattern. We call it Sawtooth because it zigzags around its hourly mean. The zigzag size are different. Sometimes they are small. Sometimes, like 1st of November, they are huge. You can see that the zigzag size in 1st of November is like €100 per megawatt hour. So it's like a 50% zigzag around the hourly mean. And it's not materializing similarly with all bidding zones. On next slide, you will see for Norway that this particular bidding zone sees less pronounced Sawtooth pattern. So we'll try to analyze together what causes these patterns. But before that, I will show you the picture of what this zigzag sawtooth pattern looks like for the whole 49 bidding zone averaged. So this complex graph reads as follows. On the x-axis, you have the 96 quarter blocks that are tradable on a day ahead. And on the y-axis, you have kind of the size of the sawtooth around its hourly mean. So if I look at hour zero comprised of 4 blocks, and you see the first block, the first quarter, is actually 5% more higher price than the average of the first hour. Second quarter, 15 to 30 minutes is 2%, third is -2, and the fourth one is -5. So this shows a downward zigzag pattern that starts up at the first quarter and down at the 45 to around hour. And starting around hour 4, the zigzag pattern reverses dynamics, and the first quarter block starts below the hourly mean, and the last one starts way above. We show the tick mark of the Q50 intervals when you average that over all bidding zones. And you see that despite these intervals are relatively short. So the pattern that you see here really is representative statistically for all zones at once. And what I see here is a 4-phase pattern where you have 2 downward and 2 upward sawtooth patterns phase. So I was thinking about what could cause this sawtooth pattern, because our role at Kepler is to model the price and in particular the sawtooth pattern. And the first insight I can share on next slide is that when you superimpose to this graph the accumulated Europe-wide residual load, so the load minus solar, minus wind, minus runoff river, well, you see that, interestingly, the sawtooth regime, red or green, seems to follow the derivative of the residual load. Let's look at the 4 to 8 hour first. Yeah, this one, we see clearly that the ramping rate of residual load is steep. And in these situations, the sawtooth pattern is pronounced and upward. When you arrive the opposite sides around 20 p.m., 10 p.m., the residual load is clearly downward, and we clearly see the reverse sawtooth pattern. Interestingly, when the residual load is kind of flat, maybe at 6 p.m. here, yeah, you see that the sawtooth pattern is almost flat also. And what happens in between is less pronounced in the middle, because in the middle we are in winter and we are consuming a lot of electricity. The residual load is not really changing. But what I see in the midday pattern looks like what the sun is doing. Like the sun is rising around 8 and maximum at 12, where the sawtooth pattern is flat, and then the sun goes down and sawtooth goes up. So you see there is, to me and to us, a link between the intra-hour sawtooth size and the derivative of the residual load. So this is kind of a picture of a static picture. Let's have a look country by country now. In the previous slide, what I defined as the sawtooth size was the maximum zigzag size between the top and the bottom. So this is what I mean by sawtooth size. And here I plot the sawtooth size over the last 6 months of every bidding zone in Europe. The bidding zone average of all Europe is 12.75%. So that's the sawtooth size we experience since creation of the new 15-minute blocks. And I see that the highest country is France in orange, probably due to a strong nuclear fleet, and as Hamza showed in his previous slide, a strangely unique pattern for France, where the 60-minute share was higher for demand than for supply. Most other countries are reversed. And then, in terms of color here, what you see is the Nordics have, in gray, have strong sawtooth patterns, gray and dark blue. Why? Mostly the Baltics countries, sorry. While the Iberian and Italian countries are experiencing lower than average sawtooth patterns. And the variability in the tick mark are huge. But this is a nice picture that is kind of pretty stable in time. And speaking of stability, next slide will show how the sawtooth size evolved since the 1st of October last year. This is the evolution of the sawtooth size. Black line is the median of all 49 meeting zones, and red is the load weighted average of 49 meeting zones. So like Germany counts more than Greece on the red line, but not on the black line. And it's interesting to see that it started to decrease a few months after the 1st of October. This kind of proportionally to what Hamza shows about the share of bids at 60 minutes at hourly granularity decreased, but then it started to stabilize the whole winter, and it did not went down in terms of bidding behavior, kept flat in terms of share of 60 minutes. But what happened starting in March is, well, basically a strong catch-up of the sawtooth effect, which is now back to its maximum level as we speak. The sawtooth size on the day market are around 40%. So it's pretty huge, and it's not going away. Why is it coming back in March? Next slide will probably show it to you. If I split that same chart per market area, I start with the south of Europe. It starts in February. It starts to ramp up in February. Then the other southeastern Europe starts a bit later. To me, this looks like springtime. It's when spring appears on these different market area. Then you have like France and Germany in March, April, and then the Nordics later at the end in gray and black. You see clearly that it seems pretty well correlated to spring. And I've plotted the scatter plot in the next slide to validate this hypothesis. For each market region here, what I plot is the solar irradiance on that hits the ground, so after the clouds and stuff, and the sawtooth size in y-axis. And the correlation is pretty neat. When you look at that over the last 6 months, you have 0.8, 0.7 R square for most market areas, most pronounced one being the Nordics, and I mean, most of them. So this just confirmed the hypothesis we had discussed just above. What drives mostly the sawtooth these days is the fact that because we still have some bids at hourly and some at 15, there is a mismatch. The mismatch when sun is rising, for instance, a hourly bid of sun supply, of solar supply, will not really, you may have a hourly bid of demand, but a 15-minute bids of solar supply will really increase between 8 a.m. and 9 a.m. because sun is rising between the two. So this discrepancy creates a sawtooth. This is one of the reasons. The other reason being that you have also constraints, interconnector constraints that can only be traded away at hourly granularity. But we believe that most of the sawtooth is not due to interconnections. It is due to fundamentally different ramping rate of residual loads, solar and wind. And the correlation is more pronounced with solar than with wind. That's the other things I wanted you to keep in mind. So strong from these insights, we've decided to model the sawtooth. And the next slide will show you how we did. So what we did at Kepler is we developed a corrector that adds a sawtooth pattern to our previously already available hourly forecast. So what we do is we keep training a hourly price forecast in blue here, which is machine learning based and trains over the last 10 years. And it kind of fits the hourly prices. But we don't have like 10 years of historical sawtooth pattern at 15 minutes because it just happens 6 months ago. So what we did is we created a corrector. We trained a corrector model that is only trained on a rolling windows of 2 or 3 weeks. And that's try to add to the blue line the zigzag patterns without changing the hourly mean. The fact that it's only training on 2-3 weeks window allows it to adjust very rapidly if market conditions shift. Let's say, even though it's less relevant because we see it's not changing, let's say trading behavior evolves rapidly and everyone starts to bid at 15 minutes, then the Sawtooth will reduce and our model will adjust in a few weeks. So that's the model, and I would say this corrector is a prudent, cautious model because basically we only apply it when we are proportionally to how good we are at modeling the Sawtooth. If we were really bad, if we don't see strong correlation, we don't modulate our signal. And for the zones where we see a strong correlation, we do. For Austria here, it's pretty striking that it's worked well, but it doesn't work as well for all countries, and I will present you the metrics after. But we made it, and one last thing about this on the previous slide is we made it, we backtested it over the last 6 months, and it has a 10% overshoot ratio. So usually it predicts Sawtooths that are smaller than what they should, so we don't want to create like false prices. 90% of the case we are kind of smaller than the actual Sawtooth, and it misses the direction 15% of the time. So sometimes we do a reverse Sawtooth, but we thought these figures were acceptable, so we put this model in production back in 1st of November. And now I've backtested the performance on next slide. This is and what I show here is the increase of RMSE, root mean square error, in percentage, compared to our model without Sawtooth. And basically, we saw that for Germany, Belgium, Austria, we gain 8 to 10% of RMSE when measured at 15-minute granularity. The impact is lower where bidding zones have no or little Sawtooth patterns, of course. Figures below 1% are negligible. So we're happy to say that this is delivered to our customer since 1st of November. And last slide to conclude is this is our front end where we expose our forecast again in blue against the actual in red. And the slide on the top here, the charts on the top shows the prices at 15-minute granularity and our forecast up to 30th of April. And you see that the actual has a lot of zigzag and our forecast has little zigzag. So okay, in this specific bidding zone, we don't model strong Sawtooth. So let's not create ones we don't understand. So that's what we did. But I wanted to finish with a quiz to ask you what bidding zone am I showing here? So the price at the top is around 100, 150. Okay. Then the temperature to the bottom, to the right is around 20 degrees or less than 20. We have a demand of bottom right, a demand max of 6 gigawatts. So it's a small bidding zone, I would say. Then around the 6 gigawatts, the solar and wind on the left is around 6 to 7 gigawatts too. So this bidding zone has as much renewable as demand. So residual demand is negative. And it also has some gas, 4 gigawatts of gas. So on the chat or whatever, tell me which bidding zone it is, and I'll reveal it after the Q&A. Thank you very much.
Yeah, so thank you for those interesting insights and also the quiz. I would say we could maybe start with resolving the quiz because I would say I'm very curious what the answer would be.
Okay.
I guess we have Germany, Austria, Belgium, and Netherlands.
Go up one slide on that, and I'll show. It's up. Sorry, not yeah. It's a small region with 6 gigawatts of demand and lots of sun. That's what I wanted to hint at. No, it's not Belgium. It is Greece. Yes, Greece is actually these days in negative residual demand territory. interesting to highlight.
Yeah, thank you.
No problem.
Yeah, great. Yeah, as I said, thank you for those interesting insights. And coming back to the question with which we have started the webinar, I would say that you have shown perfectly how many advantages the developments in the area of data has. For example, more predictability if we stick to your development of the corrector. And yeah, coming to the Q&A session, I would maybe start with the aspect of volumes that you have covered, Amza, at the beginning. And you have shown for different European countries how the volumes developed with this structural change in the market. And one question would be, why was there a decrease in Belgium at the beginning of the structural change? I
Okay,
think
so
it was at the
mm.
beginning, I would say. Yeah,
A
that was the
decrease
slide.
here in
Yeah.
yeah. So beginning of 2025 was actually, I mean, this month was a huge outlier. Very strong demand in Belgium, and strong residual demand. So actually, this month is an outlier in terms of the demand levels and the volumes associated across many years. So
Mm.
yeah, it's unlucky that the chart starts in Jan, but we would have seen it if we had more history.
Mm. Yeah, what's also interesting is that at the beginning you have, I would say, a bit of volatility, and during the more time flows through, you have more stability in the market, I would say. So this is what I'm reading here. So sticking with this presentation slide, we can see that you also have Germany and France together or next to each other, and France is of course on the first place, or so the top goaler, I would say, regarding volume. So it would be interesting for me what Germany could maybe learn from France.
I mean, yes, I mean, interesting. Exactly. I mean, France is leading on this on the salt size, on the bidding behavior. It's quite a peculiar market to monitor. I'd say first of all, Germany has already a very strong volumes in absolute value. So Germany is the most liquid market already, and there's a lot of market participants trading there. Whereas the others are more picking up. So the second most liquid market is France, and France is yet to reach its kind of full potential, let's say. So that's why I think it's more France trying to chasing Germany in terms of liquidity and volumes.
Mm. So would you say that also regarding the other European countries, maybe is this a factor for the development in the future, that countries maybe could learn from other countries so that they can stabilize their own markets maybe? Or is this not a factor where we would say this is central?
I think, in all fairness, I mean, when we look at the traded volumes, it's only fair to compare them to the demand, the power demand in the country. So Belgium is expected to have low trading volumes because there is less demand, so less physical trading happening. Where in other countries where the demand is going to be 3-4 times that, it's only normal to observe more volume. So I don't really. The only thing regarding the here, what I was mentioning, the key drivers is obviously to attract more flexible, to build up more flexible assets in the mix, and also not only renewables but any new asset types that have more incentive to go in wholesale markets to trade electricity instead of relying only on long-term contracts or bilateral contracts.
Yeah, so the structural change also has influence on developments on flexibility in the market, and also structuring it or the energy transition in general, because you have to, of course, use renewables for that. One other question would be regarding the data. Do you have data showing how prices fluctuate every 50 minutes? So I think you can see the question in the chat regarding the market conditions. So maybe we could have a look at that.
Yeah, I think Hamza, this one is maybe for you. We are asking, I think, can someone with a battery or a car benefit from the Sawtooth to charge smartly or to, yeah, arbitrage away this pattern? Um,
Yeah, I think there are two things one could do. First one is just placing your load, your demand at the right time. So obviously, if you could avoid the highest quarter hours and charge only during the lowest, that's already a cost reduction that is quite considerable given what you've shared, Bruno, with the side of the Sawtooth. So charging on the lower ends definitely will make a huge cost improvement. The next level is if you are able to charge and discharge, so move electricity from so the most expensive quarter hour to the least expensive quarter hour. So this is obviously more suited for professionals because it's kind of a lot of movement within the hour, so it might be a lot of changes for a home appliance. But these would be really the two physical ways to benefit from this.
yeah. And a question that I will take is, will this 15-minute resolution reduce the number of negative price in this summer? From what I've seen, my intuition is no. I think the Sawtooth price, they are not like as big when prices are low as they are when prices are high. So it's kind of a relative, the zigzag size is relative to the hourly average, kind of. And so the zigzag size is very small. You see it here at November 1 for Austria at 12 p.m. Price is close to zero, Sawtooth is very low. Plus, as we said, noon is where you have little ramping rate of solar because it's kind of flat at the noon. And when there is little ramping rate, the zigzags are lower. So from what I've seen so far, no, mostly it's not changing the amount of negative prices on the market.
Yeah, thank you. So maybe we can summarize this also with the answer of Amza beforehand. It's all tactics. And it also offers some opportunities. But Amza, you had something to add, I would say.
Yeah, I think there's another question that I'm seeing in the chat of what does this mean for best arbitrage? Are optimizers solely trading on intraday lagging behind? I'd say we need to put this. To put some nuance. Most of if you have a battery today, most of the value would still lie on the intraday. Simply on the intraday continuous, for instance, because it's not only the physical dispatch that you could do. There's a lot of volumes, buying and selling the same quarter hours several times, basically making money from moving prices without actually dispatching your assets. While the day ahead at 15 minutes adds a data point, so it's yet another price. So I'd like to see it as a missed opportunity, but most of the value will lie on the intraday with the intraday continuous because it's almost an untapped pool of revenue that you could get from good trading on intraday continuous markets.
Yeah, it's interesting how one change in the market can trigger other changes also in behaviors and volumes and so on. Yeah, maybe you could give us maybe a summary of your presentation, a short overview of the positive but also negative effects of the inception of quarter hourly day ahead products.
You want to go first, Bruno?
I think your first slide summarizes as well the fact that you are allowing the market to clear in a more granular way, which match more the renewable ramp-ups. And wind speed changed dramatically in 15 minutes in some cases. Solar more predictably, but still very steep in the morning and evening. And I think like we are showing 85% of 15-minute bids, so that's still 15% of hourly, but the market has already shifted mostly, and this is making price more optimal relative to grid constraints. So this is the main benefits.
Yeah, then definitely. I mean, taking a step back, it's very important. I mean, grid security, as we've seen with the latest issues in the grid in Europe over the past few years, is going to be a very important topic for the century, really, with the aging transmission lines and the aging grid. So anything that the markets can do to get closer to the physical reality and ensure the TSO's task is made slightly easier is very important, and I think that's the key here. Then obviously, if markets are able to get closer to physical reality and at the same time be efficient and create opportunities that will help balance the grids, then it's a win-win. And I think it's positive that we are going in this direction.